Welcome back. I'm Scott Voak, and I'm here with Ken Reed, Sales Manager for Finance of America, and he's graciously agreed to come on and give us some tips on mortgages. Ken, how you doing?
I'm great, Scott. Thank you so much. I'm happy to be here.
Well, I'm glad you're on board. Here we go. Let's start, because this is going to be the first of several videos I hope we do. Let's start with the basics. First-time home buyers, what are, say, three most important things that you're looking for from a new buyer when they're going to buy a house and looking for a loan?
The three most important things that lenders are going to look at are credit,
Okay.
income, and assets.
And
basically.
assets. Okay. So let's start with credit. What's important with credit?
Well, credit, just as important as the score, is the history. What we're looking for is a recent 12-month history with no derogatory events, no lates.
Okay.
There are exceptions where we can make them, but for the most part, that's the general rule of thumb.
Looking for that. Okay.
Mm-hmm.
And how about score-wise? Most people are familiar with their credit score. Where is your golden? Where is you're not buying a house? And kind of what's the minimum range?
So the minimum credit score would be a 580. Anything below that, we definitely need to work on it. And there's only a few loan programs that would accept a score that low.
Okay.
Anything above 740, you're golden. That's the score that we look at. Just as good as something that's probably as high as an 800.
800. Okay. And then kind of in between is going to affect your mortgage rate. Lower, you're going to have a higher rate. Higher, you'll have a lower rate. But those are kind of the buy.
Absolutely.
Guidelines.
Credit scores will influence your down payment minimum, your interest rate, whether you need reserves or not. The score is very important.
Very important. Okay. And then you mentioned income. What's important about the income?
Income. So history on the job, in the line of work in particular. So if you have at least a 2-year employment history in the same line of work, that's about the minimum.
Okay.
For a self-employed borrower, it's 2 years in the same line with the same business.
Okay.
That's what we need.
Okay. And what is the bank looking for in terms of how much of your income will they allow you to use for your home?
Well, the income limitations vary depending on the program, but generally 45% of your gross monthly income is allowed for a wage earner, someone who's on a salary or an hourly wage.
Okay.
And it's the same for a self-employed person, but the difference with self-employed is we can only use the net income average over the last 2 years to qualify.
From a tax return, correct?
That's correct, from a tax return.
And then assets. What do we need asset-wise to be able to purchase a home? What's important there?
So assets, believe it or not, depending on the qualifications of that borrower, can be as little as zero down. Veterans or VA, is most common with that. Minimum down payments for conventional are 3%, FHA is 3.5%.
Okay.
The purpose for using any one of those programs depends on the client. Their credit score can have an influence as to the reason why we're using those programs. Debt to income ratios.
Okay.
So it all depends on the borrower.
So those are the things that the banks look at. What are they looking for? What are the bad things? What are the mistakes people make that could stop them from getting a loan?
So one of the most scrutinized part of a transaction are the assets. Believe it or not, it may sound cut and dry that you have money in your bank and that's perfectly acceptable. You should be able to use it, but the reality is we have to go back 2 months on your banking history.
Okay.
And what we're looking for, due to the federal money laundering laws, is the unsourced deposits. Any deposits you have in your account that are unnamed, that just says cash deposit, for example.
Okay.
We're not assuming you're a criminal, but we're required to investigate. And the common mistake is people just depositing a big chunk of cash.
Like they sell a car or they've been keeping money in the pillowcase.
Exactly. That tends to be the biggest issue. Yeah. So don't do that. Do it 2 months before you're ready to buy.
2 months before. So as long as we have 2 statements, it's not necessarily 60 days. You've got to have 2 statements.
2 statements.
Perfect.
But we'll verify it, the most recent 60-day history up to close.
Okay. And then what else?
Credit. So a common mistake that people make with their credit is they're trying to do the right thing and they pay off all of their debt. But in doing so, they've also closed out maybe credit cards that have been open for years. And credit scores are based on your payment history.
So if you don't have the history, you don't have the score.
Exactly.
Okay. So that's a good thing. When I was buying a house, I closed a card I'd opened in high school for 20 years, and that didn't help.
Right.
So a big mistake. Okay. Is there anything else that people should be aware of? What about, I hear a lot about these online quick rapid scores where people are just dropping stuff into the computer and not getting the answer they want. What should somebody do, especially if they're first-time home buyer?
I absolutely recommend talking to someone with experience, especially with credit experience. Start with a lender who knows what they're doing and knows how to analyze credit. You'd be amazed. For example, if you have a collection account, It's sitting on your credit report. A lot of people would just go pay that. The problem is once you pay a collection account, no matter how old, you just updated your credit report with a fresh new collection, even though it's paid. So your scores drop.
Okay.
If you have an experienced lender, that person's going to tell you, don't pay it yet. Wait till we close escrow. We'll pay it as part of your closing costs.
Okay. All right. Is there a last mistake that's pretty common? You say?
Yeah. One more common mistake is a person thinking they won't qualify because they only have maybe a month on the job. Believe it or not, if someone just graduated from college or they went to a trade school and they have a certificate, we can actually use their income to qualify without the work experience. We use that college or vocational school experience.
So that I will have an income because I've got the degree and now I have a job.
That's exactly right.
Perfect.
And with self-employed, the most common mistake is writing off too much on your taxes because we could only use net income to qualify.
Okay, now I want to talk a little bit more about self-employed, but that's going to have to be another episode. A couple things I really want to hit is we've got a lot of clients who are self-employed and they're doing exactly that. There's a lot of pitfalls. So next time, let's go into the self-employed, and I also want to talk about investors and investment loans.
Absolutely happy to do that.
Perfect. Hey, thanks for coming on.
Thank you, Scott.
Hey, everybody. Thanks for watching. Until next time, make it a great day.